Welcome to Offshoot, the Fident Capital podcast with host Kevin Choquette. Offshoot is a curiosity-driven conversation that features a wide range of real estate and business professionals. In each episode, we unpack the knowledge, vantage point, and domain expertise of our guests. Then, we move beyond the facts and figures and dive into the personal habits and mindset which allow them to be high performers in their respective field. This podcast's objective is simple: supporting entrepreneurs, fostering relationships, and uncovering meaningful conversations that positively impact business.
Hello, everyone. Thanks again for joining Offshoot. I just finished speaking with Jon Lotter, today's guest. He shares some excellent insights for both life and business in this one, and I hope you enjoy it. Some highlights before we jump in. Larger deals pay more. Do those. Conservative underwriting is a differentiator. You hear throughout how Jon and the Appian team say no to deals on a regular basis because they simply can't meet their conservative underwriting guidelines. We speak a bit about force majeure provisions and the impact they're having on guaranteed maximum price general contracting contracts and cost containment in this environment in general. It's worth stating it's March 9th, 2022. What it looks like to be opportunistic and seeking the best deals throughout the investment cycle. They've narrowed their investment focus and have just continued to go where they find the best risk-adjusted returns, and they are not anchored to that and will move it as the cycle changes. We discuss a bit co-mingled discretionary closed-end funds and why they are fundamentally mismatched to the real estate investment business, a fascinating and kind of endless topic in my opinion. We also talk about why having the ability to say no thank you to investment opportunities forever is a material competitive advantage. A lot of the competitors to a boutique firm like Appian don't have that liberty. From an underwriting perspective, it's first who, i.e. first the developer and then the project. From an underwriting perspective, it's also expect the headwinds and be happy if and when they don't happen. And then we talk a bit about, the accomplishments that Jon's made and what he might be most proud of. I don't want to sort of get ahead of it because I think the insights there are quite profound, but it's related to fulfillment and success and what that can mean for his children. Really nice notion that he's sharing. A couple other things, keeping it simple. This business actually isn't that complicated once you kind of get enculturated, and finally, as a tool to combat the noise associated with life in the 2020s, simply being intentional, being mindful with what you do to stay on track. I hope you enjoy the episode. Hello, everyone. Thanks for tuning into another episode of Offshoot. Today, I'm happy to welcome my friend Jon Lotter to the pod. Jon's the managing partner of Appian Capital, a Bay Area-based investment manager that typically invests joint venture equity into opportunistic real estate projects. That does not, however, preclude them from investing for duration, rather than simply building, stabilizing, and selling, as many fund managers do. Whether their projects are developments, repositions, or renovations, they almost always work with local operating partners, the GP yin to their LP investment yang, if you will. Over Appian's first 20 years, the firm's invested over $400 million into properties with a value north of $2.2 billion through approximately 140 transactions covering 16 unique property types. They've yielded just north of a 21% IRR, an impressive 20-year track record. Jon's a Berkeley grad, go Bears, and is always running and gunning. I suspect you'll see very quickly here that his mind moves at the proverbial mile a minute, but I'm cautiously optimistic that the two of us can keep this pace slow enough to avoid giving any of you, our beloved listeners, whiplash as it gets going. Jon, I'm very thankful you've taken the time to speak with me and share some of your insights. Welcome to Offshoot.
Oh, well, thanks so much for that great introduction. And yeah, do have a quick cadence to our conversations, don't
Ye-
we?
yes, we do. How's work these days? What's happening over there?
It's a lot of fun. Our posture is really just in reaction to what we're pitched and what we're seeing. Irrespective of our asset management roles, um, and those projects that we find, we get excited about, and that's what kind of fuels our enthusiasm.
Yeah, good. It's a busy time. As like a starting point, could you just tell us a bit about Appian and yourself and kind of give an overview of the platform? I have some familiarity with it, but uh, the elevator pitch, if you like, just a bit of
Sure.
background would be welcome.
Um, as far as background, I in a previous life I was in investment management for large firms, BlackRock and Franklin Templeton funds, and I found I just lacked the enthusiasm for that business and was always on the side pursuing real estate ventures. And so after nearly 5 years, I quit and joined a small family office where they were making direct investments, but also uh, partnering with in a joint venture, and then also had a mezzanine lending platform. And so, small enough office where coming in new as a junior guy, I was wearing enough hats. Um, and lucky for me, the fellow running the place was very hard to get along with, and I went off my own after less than 2 years, and started Appian with the backing of some of those partners. Um, and back then, we were focused on mezzanine debt, preferred equity, and JV equity, and but did that for those programs for a decade, and then kind of winnowed it down to, for the past decade, if you cut it that way, kind of pre and post recession, have focused exclusively on JV equity um, only, and don't want to do or get involved with any structured financing.
Yep. What's happening in the business right now? What are you guys seeing? What challenges are you facing?
So I guess a lot of our daily is reacting to deals that are pitched to us, either directly from developers or through capital placement folks, or just through other channels. And a lot of them have maybe I would say optimistic exit cap rates, or optimistic cost structures, maybe not layering in enough contingency to account for the highly variable costs, which are kind of just um, uh, part of the backdrop these days. And so I think we look at a couple deals a day and pass on most all of them. Um, and then, but we get excited about are those that are have a little more conservative assumptions to them. I don't know if that answered the question.
Yeah, sure. But so you're saying developers tend to wear rose-colored glasses?
Yeah, and that's one thing that's been true. But there are some when, and if they say you know we expect it to be 8 and it ends up being 10, that they're under, and that consistently happens, and we can really see that they're not banking on rent trending, and they're not banking on these things happening perfectly, and it still works. Then we're intrigued, and we move to the next chapter, or then we dig in a little further. um,
Yeah, and you mentioned cost containment. I mean, every conversation I'm having is focused on this and inflation and hard costs. I'll call it appreciation. I don't know. Inflation's probably a better word.
right.
What are you guys doing to mitigate that? I'm even hearing a bit from even the stronger general contractors that, putting up a GMAX, even for them, is
Yeah.
getting to be difficult and maybe prohibitive. What are you guys seeing in that side of the
Well,
business?
in those projects, so we have a GMAX contract on every deal, and the capitalization to back that from the GC. Um, those so at any given point, we're in the midst of. Oh, let me back up. So we're focusing mostly, nearly exclusively, on ground up development of multifamily,
Hmm.
and these are mid-market, which has always been our niche, um, below institutional um, check writing, and so for that, these days, uh, it's in the high teens to mid 40s is our equity check, um, millions, and then so that's kind of gives you the scale of the size uh,
Was
of
that
our deals.
mid-teens to 40s is your equity check, or that's
Yeah,
total project cost? That's your equity check. Okay.
that's our equity check, and so in various markets it's different unit counts. In Phoenix, that might be 300 units, and in a more expensive market it's lesser units. Um, and we're those projects that are ongoing, over the past year and a half or so, we have to go through a value engineering effort to see how we can um, mitigate some of these things. And so you have a GMAX contract, but they have force majeure clauses, and these were I understand that the difficulty now signing a GMAX contract, because it's still variable, but that force majeure language will probably uh, carve out pandemic or COVID related things, because that's a known um, variable now, whereas before it wasn't, and so they can hang their hat on force majeure claims, saying it's a global pandemic, and so
You're
we're off
saying
the
so,
hook.
like if you have a 2020 vintage GMAX and you're coming to the completion, they're gonna hang uh,
Yeah,
they're gonna hang like the latitude, if you will, to break the budget on the force majeure.
yeah, saying, hey, look at labor, or supply chain issues or whatever it is.
Yeah.
Not the, but the materials were locked in, likely, so you don't have the big lumber swings, or steel or copper or whatever.
Right. They would have bought that out on the front end.
Yes, yeah,
Yeah.
exactly.
And so what about a current vintage deal? I mean, I saw
And
in your
so those that are being conceived right now, we it's we layer on a lot of contingency, and we dig in. You know, we just closed something a couple months ago, and we bought out everything ahead of time, ahead of schedule, um, just and warehouse it near the site to insulate from supply chain issues. And so you have all these ways to mitigate. It's not perfect, but um, for those things that you don't know, you uh, carry extra contingency for, um, and then with that extra contingency in the budget, so you have with that inflated budget, if it still works, then we get involved with it. But if it doesn't have that, and if it's lean and doesn't contemplate those variables, then it's kind of like threading a needle, and it's usually we just back away from it.
an easy pass. Yeah.
Yeah.
Um, and, and look, I will tease out of you a bit more about your current investment activity because I think it's worth sharing with the listeners. But just on the topic of uh, development costs, and we sort of ran back of the envelope analysis the other day, um, and came to the conclusion that like what I'm about to say is going to be influenced by the prevailing cap rate environment in terms of what the terminal cap rate is and what cap rate on cost you're building to. But assuming you're building to 5.5s and you're exiting at 4s, which would be very appropriate for kind of Southern California and probably the West Coast more broadly, or at
Hmm.
least California. Um, we came to the conclusion that a 3.5% increase in costs, just total cost, can drop 25 basis points of yield out of the stabilized cap on costs. And
Yeah.
so, like, my question to you, given what we're seeing, is it seems like a Goldilocks moment to develop macro, because inflation hedges and the fact that rents typically move with inflation and you're borrowing long-term fixed rate debt, so owning real estate in an inflationary environment is pretty attractive. There's a ton of capital that wants to come into real estate because there's no yield anywhere else. But, like, are these cost escalations going to be significant enough that the development window closes?
Well, I think that, it depends on your perspective. For us, yes. But for those who are along the land and spent 3 years entitling it, no, they'll say we're building to a 5.1 or a 5 or 4.9 trended.
Yeah,
And so
trended.
so that goalpost keeps moving, and that makes us nervous because then they say they're exiting at a 3.5 or something like that, and we're saying, yeah, I understand that it's supported today, but the sun is shining today, and it doesn't always the sun doesn't always shine. We've learned, so we build in, cap rate escalation of like 15 bips a year or so. So we need more of a conservative exit cap idea out there, and so that's why we don't trade a lot in major markets, because a lot of those pro formas need the trending in order, meaning they need that to build in that rent growth assumption in order for their pro forma to work. And in some instances, we run it at a 0 and then say, guys, you're kind of selling it for what you're building it for. Like, oh yeah, well you took out the market growth.
Right.
Okay, yeah, but if this is just a market growth play, then we would buy the existing Class A building next door to you
Thank
and
you.
ride that market growth and not
That's
unless it's,
exactly what I was going to say. If that's the
yeah.
case, let's just go buy one and not have a partner and not have to take all of the development risk.
Why go through? Yeah,
Yeah.
exactly. But
Yeah.
to some, they have a hammer and everything's a nail, and so they do that because that's just what they do, and they're pregnant with the deal. So
Right.
um,
So let's
it,
talk a little bit more about where you guys are investing. You just alluded to the fact that you're less frequently in major markets, but asset types. You kind of alluded to 15 to 40 being your check writing, which is larger than I recall. Geographies, primary, secondary, tertiary markets, like
yeah.
just development, entitlement risk. Where are you guys investing? What's the sweet spot?
And so the check writing size has changed over the years, not because we aspire to, do bigger deals. It is fun to do a larger deal because all the remuneration is larger, but more that those deals happen to be ones that we're following our developer partner down to, and it happens to be a larger transaction, but we have kind of a shorthand communication with them. This is our sixth deal or something, and so and it also is driven by the inefficiency in the market below where maybe Carlisle or Prudential will write a check, where they have to. It used to be that below 15 million was a sweet spot, or 10 million back in the late 90s, early 2000s, and now as they raise more money, their denominator gets larger, and their transactional efficiency, bright line below that, it's just too small. If that makes sense.
It does make
Um,
perfect sense. Let me just say that back to you, so I'm making sure I got it. What you're saying is, as the bigger funds get bigger, their smallest check is bigger, which gives you a bit more headroom to write
that's right.
bigger checks and still be sub-institutional.
Yeah, way better said than what I just did.
Yeah, that's great.
Um,
That's great. To be honest, I haven't heard anybody say that, and it makes a lot of sense.
Yeah, and it's just it's not because kind of we're brilliant. It kind of happens that way, and we're partnering with folks who otherwise have those big funds as partners, and but they had this smaller deal that they have because they're in the business of the business they're in, and so we'll partner with them on very in a similar docs and bargain that is kind of on the shelf for them with big pension funds.
Hmm.
Um,
That
and
sounds like a win.
yeah, and so it's very much it's easier than dealing with and we absolutely appreciate and get excited about local, regional, more entrepreneurial developer partners. Um, but if they haven't been beaten up by Prudential, they're not as they're not as you know th- they're looking at our terms and going, oh, that's different than the doctors and dentists I raise money from.
Right.
Um,
Totally.
um, so I know that's kind of a weird way to say it, but it is kind of the what we notice in terms of the
No,
timing
no, look, it's
of
the natural evolution of
yeah,
the, if we can say, the emerging manager, local real estate entrepreneur, first deal or two, friends and family, maybe he
yeah,
raises 2.5, 3 million, gets a win, does two or three, and then suddenly wants to do a 140 unit project, and he's not going to get the local syndicate that he has
right,
trust and affiliation with to write a 14 or $20 million check, which is where he comes to you and he says, well, and by the way, I get to be the messenger for this. How about a 10 pref 50-50 split?
yeah.
Right.
And you provide credit enhancement and guarantees along with me in pro rata, along with me, and I'm the 5% partner, whatever it is.
Right. And forget that my net worth and liquidity is, let's say
So it's really you.
400,000 with
Yeah,
4 million, and we're borrowing 40 million, but
yeah,
we'll both sign on the guarantee.
yeah, exactly.
All right.
Um,
So that's super helpful in terms of check size, but what, asset classes, primary, secondary markets, tertiary markets,
we used to
entitlement
look,
risk.
yeah, we used to, kind of look at major or major property types in terms of the pie chart and fill out, the different quadrants in pro rata and go, oh my gosh, we haven't done industrial that much but to be diversified, let's let's emphasize that. And we let that all go after the recession and just kind of followed what what's in front of us. What's the most attractive given these times, and um, so aside from a couple hospitality, we built a hotel in Silicon Valley right near the Apple campus, um, and some office, which is they have really good stories attached to them. Outside of those, it's been ground up multifamily, and I expect for the near future for the deals we have in the pipeline and what enthuses us in terms of risk reward is multifamily development. Um,
Hmm.
in terms of location, um, I want to say we follow job growth, but gosh, we had just an awesome time, and we pursuing more in like market like Eugene, where there isn't a big job growth story, but it's a scarcity story in terms of the existing inventory, and there's not a lot of developable um, parcels within the urban growth boundary. Um, but those places where we have been and continue to do a lot of business are kind of like Phoenix, MSA, in Tempe, and various parts, just draw a big circle around Phoenix. And Boise, we are now on our one, two, three, fourth transaction in Boise. We during the early days of the pandemic, we kind of leaned into that market on one deal, and then consummated that, and then but with those efforts, it was not a lot of folks were pivoting there, and now it's a little bit of a darling, but and there's been a lot of appreciation since, but um, uh, we are bullish in, for on Boise. It reminds us of what Phoenix looked like a decade ago.
Hmm.
And other markets you're kind of looking at a little bit. We tried to do some business in Salt Lake, but it hasn't gelled yet. So
I'm
we're
reluctant to
open.
ask a question that I know Google could answer, but in terms of like orders of magnitude, your comment on Boise and Phoenix is interesting to me because those population centers are vastly different just in terms of
Yeah.
head count. What is it about Boise
I know
that
I
looks
mentioned them
like?
in one sentence, but they are very, very different markets where,
Yeah,
you know,
I mean it's hundreds of thousands in Boise, right? Like maybe 200. What, I don't know the population of that MSA.
yeah, I mean, and you have to look at, it was, we were underwriting Sunnyvale where there's, uh, you know, millions of square feet. We were throwing around millions uh, of leased and then, purchased and being developed right near you, which, we were excited about that happening, blocks away from our site. And then switch over to Boise where, um, it's like 100,000 square feet right there. And oh,
Right,
wow, that's right there,
right.
and we're similarly excited just because, but it's just a way smaller pond. Um,
But what is it that makes you feel? I'm just curious. I want to sort
yeah.
of explore that. That it has some characteristics which are similar to Phoenix. It's obviously not the population. It's
Yeah, the population's, it has a big immigration component, but and which was, the pandemic was a catalyst for, but it was there demonstrably before the pandemic in a consistent way over years. Um, and so it's very, it's just back a decade ago in Phoenix, where you had a very industrial base that was kind of just one leg to the stool, and so it was kind of a more volatile market, whereas really the industrial base was built around housing generally in construction with mortgage companies and all the ancillary businesses. Now Phoenix is a very diverse industrial base with tech, biotech, financial services, insurance, and whatnot.
hmm
Um, and Boise is having similar attributes in terms of
yeah, yeah.
a diverse job base, industrial base.
Employment based, yeah, diversification, and it's
Yeah.
760,000. I just looked it up. Thank you, Google. So it's actually bigger than I had appreciated.
Yeah, I mean, the size of it. I mean, there's all those suburban areas, and so when you talk about MSA versus the downtown core, I mean, there's a lot of development out in Meridian and Nampa,
hmm
which we're looking at those too. Our developments are right in downtown Boise proper, which there's a dearth of housing. There's more coming on, but when a project is delivered, it's the velocity is in the 50s versus in the teens or 20s in other markets. They're just because it's just an underserved market. Um,
Yep. So it's the emerging manager, Western U.S. Sounds like it's mostly secondary and tertiary markets. Clearly, you're not afraid of some of the smaller markets, meaning the Eugenes or Boise's. Development is front and center. What do you guys do as it pertains to entitlement?
yeah, and in terms of I'm more afraid of. I live in the Bay Area. And when I see a deal in the East Bay or San Francisco or South Bay, not much in the North Bay, those scare me because they're just the metrics of the deal, and they bake in the growth um, where and they don't have just the new growth right there. We're not making prognostications nationally and then doing circles around areas. We are looking at local, regional characteristics and making a rifle shot investment right there. And that's kind of so that's why Boise fits.
hmm
um, and we run it at some conservative assumption that it still passes the test when we stress test the pro forma. In terms of entitlement, um, we have had in years past entitlement funds which just took that piece of a risk and then handed it off to a more build to core fund or other internally kind of a stop start, and we don't do that any longer. So we don't really get involved with, I'll call that pursuit, or we kind of react to a deal once it's actually a viable deal. If there's some administerial entitlement work, which is not anything, no discretionary review or anything like that, then that's the point we get involved. We do, however, get involved with deals that have a big entitlement effort to go through, but we're more just there, haven't invested yet, and maybe are trading paper in terms of our bargain, our agreement, so we can hit the ground running once they do gain that.
Yep, that makes sense. And then as it pertains to the nature of the capital that Appian deploys, are you guys a fund manager in the traditional sense where you're on fund 2, 3, or 4, and each fund is $100 million, and you're getting an asset management fee and a promote, or are you working in more atypical manners and sort of recruiting capital in the real time? I think I have some insights to that, but I
Yeah.
certainly wouldn't want to guess.
So while we're raising some funds right now, those funds act as kind of Uber investors among our other investors. And the reason that we abandoned the go out on a roadshow and raise up $250,000 and then spend it is that philosophically we feel that's it doesn't match. It doesn't feel good in terms of, hey, we're sunsetting this fund, and so we have to dispose of these assets, and so we're really, we'll take a haircut on that, and it breeds ill will with our partners.
Yep.
And and a lot of that's just for marketing, for raising funds. So fundamentally, we don't look at ourselves as capital raisers. We look at ourselves as folks who find deals that we're enthusiastic about, and then invite others to invest in them. But in terms of our posture to the market, we need to have the funds to fund a deal. So we have agreements with a couple ultra high net worth folks who back our program and who can write the check in a minute to back 100% of everything we do. And then we make our commitments based on the strength of those, and then but where the rubber hits the road, those guys who are making that commitment only end up being a couple percent of any deal, and we have maybe 400 and so investors, and each deal is a separate transaction, and the decisions made on that transaction are driven by the real estate, the property, what is right for the property. And that is a breath of fresh air for a lot of our partners when we say that, because they're like, oh, great, okay, because so if we're hitting, you're not going to have some liquidity constraint and say, gosh, we got to lock in the loss here and sell. You'll never hear that from us.
Well, not only that, but you're not in year 7 of a fund where you're looking to recognize your 20% promote as a fund manager. And in order to be able to do that last asset that really isn't ripe, and even though the cycle's kind of moving against you, it's more or less a forced liquidation because you got to get paid.
Exactly. And then it also adds a perverse incentive for us to transact because we raise the money, we're getting paid, and I've seen this with folks who do similar programs as us. Their deal quality just goes down, and like I'm scratching my head. We passed on those. Oh, yeah, they just did a big fundraise, so I guess they have to spend it.
Yeah,
but
that's
but
exactly right.
that, oh gosh, and maybe they'll do well, and maybe the market will keep rising. But um, you're
One of
catching
the
me. Yeah, go ahead.
well, one of the endowment managers for one of the big universities on the East Coast, I've heard him in a room full of, sort of the fund managers that we're referring to right now, just literally say, I hate commingled funds for the exact same reasons that you're
Yeah,
articulating. Like
yeah,
it's bad for the real estate. It's you're taking my discretion from me, and you're mingling me with a bunch of junk of matched duration, and then you're going
yeah,
to synthetically drive the thing off of a
yeah.
cliff in year 8. Like, what are we doing, guys? Like, what are we doing?
Exactly. And
Yeah,
that could be a whole separate podcast, or how I think that money
totally.
is raised that doesn't match the actual investment thesis that you're pursuing.
Right.
And you're catching me in terms of professional arc. So I'm 53. We don't need we can pass for years.
Right.
Actually,
Right.
I could just ski and mountain bike ride from here on
Right.
out. So I want to get into things that are positive, and and it's better to under promise and over deliver. And then, oh, did cap rates compress? We're out. Wow, that's great. And so it's all a positive spiral in terms of life balance and everything. That's much better than saying, yeah, we had hoped that market, we'd underwritten 4%, and it didn't happen, and it's bad news, um, or less good news or whatever. Um, and I'd prefer the former to the latter, in terms of a
Mm-hmm. Well, look,
balanced life.
yeah, I totally agree, and I think I think you guys are really wise to approach the market that way. The thing that you have that's unique is, I think, what you just labeled as kind of the Uber investor, right? Like to be able to stand, with confidence and say, "Hey, we'll take the deal down. This is our terms," and know that you've got the backing, and then the market would sort of require that. So it's a,
From the
I,
outside looking in, I think it looks a little bit like Frankenstein's monster. I mean, it's a little, but we were like, what are our priorities? What do we want to do? We don't want that. We want this. We want freedom to do what is the right thing to do for the property, and for our partners, frankly. Um, and we
and
came
you've
up
done
with
it
this.
with $400 million, so it's not like it's a de novo concept at this point.
Yeah, no, it's um yeah, we're way downriver on it. So
What do you attribute the $400 million and your 21% sort of average or aggregate IRR? Uh,
I kind of
yeah,
cut it up into the first decade and the second decade, and the first decade's transaction flow and deal size and type are very different, especially when you come to a mezzanine fund. A lot of maybe 60% of that deal flow from year 2000 to 20, I'll call it 2008 maybe, was mezzanine debt, and that's a whole different kettle of fish, and it doesn't. So, um, and that had reasons for its success, which are different than what we have done since uh, 2009 or so to present, and what we expect to in the future. And that is all very consistent. Like, meaning for the past decade, we did what we intend to do for the next decade.
right.
Um,
And let's talk about that first 10 years, because I have heard you in other settings, um, sort of articulate some of the reasons that you moved away from
yeah,
that business model following the Great Recession, following the downturn. Like what were the lessons learned in that time period?
I think that uh, a big staff and looking to do more volume, and getting into more structured transactions, and we were, a lot of those preferred equity and mezzanine debt uh, investments we made did wonderfully well, and sometimes they did wonderfully well at the expense of our partner, because we were in a preferred position, and if things go wrong, then we're still great, but they are, they worked for free, or they,
Mm-hmm.
um, and so and because you are in a protected position, you can convince yourself to get involved with deals which are maybe have a little more hair, or are less stellar. Um, and then on the joint venture deals, it's more who than what, and those the information flow of being a partner, that is, I think, just fits how we are, how my partner and I are organically, how we are we approach it more as a partner and not as a lender or some preferred bargain. So it matches our personality better. We like rolling our sleeves and helping and leaning in, and not tasking our partner in terms of, we try to answer our own questions and have our own resources. Um, and so the JV equity bargain or structure really fits our character and nature better. And there's a higher quality of sponsorship. And then when you focus on that, then um, uh, and doing repeat deals with those is just the best place to be in terms of a fun business to do.
And look, as the industry as a whole, the business you were in, and the same as the big fun business, um, we're in an ecosystem where there's a double promote, right? Which is the developers getting a capital or a profits
Yeah,
interest that is disproportional to their capital investment. And as a fund manager, obviously, your incentive for doing this is you can get a bit more of the economics than you would for just the dollar for dollar investment
yeah.
that you may make into any transaction. What's your view of the double promote in general? Like
Yeah,
it's
so we're not inventing anything that Goldman Sachs or Carlyle or any of those others.
that's right.
They all so it's an on-the-shelf bargain that's out there, uh, with 99% of the money that's invested in real estate. Uh, so all those funds have a double promote. So
That's right.
they're when they're investing in deals, you look at their prospectuses, and they don't mention that, but we know, because we see the transactions where, oh yeah, no, that's a JV bargain they're doing. They didn't buy that building; they bought that in partnership with the local local guys. So we are, doing what is most normal in the main. Um, but when it comes down to the perspective of an individual investor who has maybe $10 million, who represents maybe one of our investors, he may be looking at us, or investing in maybe someone he knows, a local developer, where he's coming in as maybe their co-GP, or coming in as their, part of their equity syndication. Yeah, we are different there, but we have what he doesn't have, is we have guarantee from our developer for that they're on the hook for all cost overruns. Uh, that's that has always been the case, and it's well capitalized, nation's largest developers. And then also, we are on our hamster wheel working, and finding and being very discriminating, so in diverse areas, so that his friend who at the country club, they're going to have one type of business they do, and so if he wants to go, disproportionately invested in that one, and then that's one thing. But we have some.
Yeah, yeah. Look, that's all great feedback, and I wasn't meaning to contest that the double promote was
Oh yeah,
unjust or
yeah,
anything like that. It is a market bargain that's out there, and I think the general consensus is it's worth it, right? Like if I as an investor, I would be happy to pay you guys to have somebody looking in Eugene and Boise and making sure I'm getting best of class. Sponsors, local developers, high quality general contractors who can put up a GMAX that means something, know
yeah,
that I'm in a market where the job formation or household formation metrics are favorable, or the supply constraints are so meaningful that you can almost not look at that as much, is kind of what you articulated with Eugene.
right.
I think it's worth it. But like a parallel to that, the crowdfunding thing,
Yeah.
the Jobs Act that Obama passed now, I don't know,
Yeah.
9 years ago. Crowd Street in particular, there are others. It's starting to be pretty real. I wonder what your
Yeah.
thoughts are. Like, is that a threat to Appian and its brethren? Is it
I,
going to
you know,
reshape the industry?
when I saw when we see those, I've noticed, those. I saw an offering and by Graystar on there. Like, oh gosh, there's, that's interesting. Maybe we should pay attention to that. And then I don't know. I saw something shiny and abandoned the research into it. But uh, um, in terms of the bargain, in terms of the deals, um, uh, it's it doesn't have the characteristics that ours do, so it's a little bit of apples and oranges. I don't think it's a threat just because we're dealing with um, relationships and larger capitalizations that those aren't large enough yet.
Hmm.
Um, but hey, they are getting larger and larger, and folks are raising funds out there, and I like the democratic nature of it. In some, you know, uh, the crowd streets or real crowd or whatever, they try to offer up some type of, here's what to look at. Here's some, underlying, you know, uh, um, underwriting that you can look at. Um, but it's not professionally vetted. It's not, and so there are things that I've noticed there, like, oh gosh, they don't mention this refi thing at all. And I mean, they're mentioning that they are going to, but they don't mention, like, their assumptions around it, or whatever. I'm using that as an example of, there's some blank spot somewhere sometimes there that, oh, that's interesting, and they got funded. Okay, yeah, and they'll likely do well. I'm not betting against it at all. I'm just saying what we're doing is different.
Yeah, and I think they will do well, and I don't think it's a threat. And the way you just articulated it at 53 years old, and I suspect the challenge for Appian is uh, having the correct proportion of no's to yeses, and the no's
Yeah,
vastly outnumbering the yeses. I don't think CrowdStreet or any other crowdfunding platform will upset that kind of balance, but I do think it's in the coming years. I think
yeah,
the industry is going to uh, shape shift a bit, if you will.
yeah. I'm intrigued by that idea, and I want to pay more attention to it. The uh, um, because it's, if you look at the growth trajectory so far and extrapolate that, it looks very promising for them.
Yeah,
Um,
yeah. I think they did $1 billion last year and are projecting to CrowdStreet in particular. I happen to know those guys pretty well. They
mhm.
did $1 billion of equity raised last year. The average check is like $25,000.
Wow.
They have 16,000 accredited investors on the platform. It's
Yeah.
it's fascinating. Well, let's go
Yeah.
macro. Like, talk about the cycle as a primer. I just listened to CoStar. Um, they did a market update for San Diego. So here's a few sound bits: 3.5% cap rates for multifamily east of Interstate 5, 3% cap rates for assets west of the 5. They expect those to drop 10 to 20 basis points. We're out in the market right now looking for a stretch senior loan at 85% LTC, which historically would be a very aggressive ask. That's 18.5 million.
Yeah.
We got 10 bids. 4 of them are over 21 million, which is like 92% loan to cost. Or I should say
Oh my
over
God.
20 million. Excuse me, they're over 20 million. And all of them, this is all like, private debt, non-recourse capital, are an 8% rate, and the median fee is like 2 points. So we're in a point where apparently 4 private lenders are comfortable at 92% leverage for 8% and 2 points. I could go on, but like, what's your guys' view of this cycle? Like, where are we? Like, is this just lean in because inflation's ripping and it's all you can do, or is this time to pull back and be really cautious and convert to cash and wait for something to happen? It's very hard for me to see it at the moment.
Yeah. So, we operate a build to core strategy. So what that is um, instead of buying that Class A apartment building, we'd like to build it and own it. So build to a core asset, and you have the Class A apartment building in a A location in a growing market, and so that's our strategy. So our notion is, even though we're partnering with merchant developers and they want to top tick their IRR and build, lease, sell, and you didn't hear stabilize, sell. You said build,
That's
lease,
right.
sell,
That's right.
which is nowadays, gosh, we're before we have C of O, we're getting offers on our properties,
Mm-hmm.
um, and uh, and and but we would buy them out, saying if we sold it for what we all agree a value is, then this is what you would get, and we'll buy you out, and then we're going to write off in the sunset and hold this asset. So that's generally our business plan. And on the recently, because of the froth in the market that you just described, we were just seeing BOVs on our deals, and just we just built it and we're doing initial lease up and we're maybe halfway through or 50 or 60%, and we get a BOV that's valuation which is just sky high compared to our pro forma. And we're not we in that refi or just buying them out, we're buying their portion out at a 3.5, and I don't want to buy. We want to sell into a demand wave, and if this isn't a demand wave, I don't know what is.
That's right.
So we have been selling. So we've been selling a couple assets, and we'll probably sell and then redeploy that into those deals where we are building to a high fives or a 6 cap, depending on the market, or maybe mid fives cap rate. With a 200 basis point cap rate spread versus the market cap, and that I think is probably the best thing for us to do right now if we can find those deals to do. We're ambitious. We want to do a lot of volume, but it's it's difficult being with our conservative temperament and and do a lot of volume. It's like if you want, I want to you can have 2 of 3 things when you're making a movie. Good, fast, and cheap. Pick 2.
That's right.
So we have to. So we've given up on volume as opposed to quality. So
Mm-hmm. And if you pull out your crystal ball, which if COVID taught me anything, it's that my crystal ball is completely dysfunctional. But what do you guys? I mean, where are we? Like a couple more sound bits, right? There's $14 trillion of cash at the banks. There's $7 trillion of cash with investors. Okay, if you apply even modest leverage to those kind of numbers and then take a tiny slice and allocate it towards real estate,
it's crazy. And I mean doing business through the recession, we just in pre-recession, I think we'd go, oh no, we've been doing this. It's for so many transactions for so long. I think I told my wife, no, I'm pretty sure it's going to be the same thing next year. That now is the best predictor of tomorrow. And talk about broken crystal ball.
Right.
And so now we expect headwinds, and we expect bad things to happen, and bake that into our numbers. And so if and we kind of do this big. Most of our presentation on our deals, or to ourselves, is talking about risk mitigants as opposed to the positives of which we wouldn't be there if we didn't see positive, exciting things happening. But when we're convincing ourselves to invest in it, it's mostly talking about risks and then how to mitigate those discrete risks. And I don't know, 4 different pundits will have 4 different opinions, and I'll read an article saying one thing and another article, saying the opposite. So I just we're just kind of agnostic to that and say, okay, let's just expect bad things to happen.
Well, and look, you've alluded to a lot of the when I get what you're saying, let the pundits be the pundits. In the meantime, I'm going to take it to the asset level and make sure each decision is prudently underwritten, and that's the best I can do.
Yeah, yeah.
Yeah.
And I mean, maybe we should have another fund which says, okay, based upon our ideas of the future, this is this is the more of a rocket fuel type of investor. That's more of a private equity idea.
Well, but you had hinted at just throughout the conversation, right? Perhaps 200 basis point spread between stabilized cap on costs and the terminal cap rate. It sounds like you're underwriting untrended rents. It sounds like you're going to expect cap rate expansion from, if the market was 4, you might underwrite a 4.15 or a 4.3 as your terminal cap rate. All sort of downside variance, but outside of that, like, what are the metrics or attributes of deals that allow you to, you also alluded to start with who, it's the client first and then probably the deal and or market. What other, if you will, tricks of the trade or mindsets do you employ to sort through? I mean, it sounded like
Well,
it's
that
probably
initial,
1 out of 200, right? Of the deals.
yeah, and that initial um, metric of the cap rate spread, um, you know, and it's not terminal cap rate, it's stabilized cap rate, so it's nearer term. But these are larger projects, which that nearer term to build and lease is under 30 months, but call it month 28 or something like that.
Mm-hmm.
So then we'll add, in that instance, maybe 30 to 45 bips to the cap rate and say, okay, and that's not that far to layer on that much. And so if we think it's a 4 cap market, then it's a 4.5, or if it's a 5, then it's a 5.5, roughly, or 5. But anyway, and uh, it's hard to have a general framework in terms of because each deal is a story, and so
Mm-hmm.
as the nature of real estate, which is alluring about it, and that is that each deal is a little puzzle, and it makes it a career that is fun to do over the long haul, because
Yeah.
each deal is a different story, and they're building a hospital next door, or this is the last parcel here in this area, or
But
the
are you
tenant.
also saying that
Yeah,
that first metric, that say 200 basis point spread, is one of the first, like, it makes the triage easier, like, yes or no, or
yeah.
maybe, yeah.
But embedded in that are assumptions of what's the cost is a conservatively derived cost, and then is the rents, is it a reasonable idea for the rents building up that terminal. And then also, if you are in a more tertiary market or product type, where it's that cap rate spread expands as you get
Mm-hmm.
to higher cap rates and compresses. So if it's from a 4 to a 3, that's the same profit, or maybe more so than from a
5
5
to a
cap
4.
to a 7 or something like that.
Yeah.
Or a 7 to a 5. That 200 basis points is probably less profit than from a 4 cap to a 3 cap, just because of the nature of
Yeah.
how that function works.
Yeah.
So it's not. It's kind of Kentucky windage, as it were. It's kind of like that's generally okay. Here's some decent metrics here. Oh, we're excited about this location. We built the neighboring property or something like that.
Yeah.
And
Look,
and
the
and the
thing that
who
you
too. Sorry.
yes, but the thing that you just said on that, like cap rate spreads compress as yields nominally drop,
Yeah.
right? Like
Right.
I don't know that there's a lot of, I mean, it's a mathematical fact, but I feel like there's just this convention that like, okay, you should have 150 to 125 basis points of spread between your terminal cap rate and yield on cost. Well, okay, but let's do the
Right.
math. If I'm building to uh, a 6.25 and selling at a 5, like that's this return. If I'm building to a 4.25 and
Yeah.
selling at a 3, that return is like
Uh,
2x
yes.
of
Yeah.
the same. Yeah, you're
And in years past I had difficulty explaining that to someone who worked for me, and so I just put it on an Excel spreadsheet and say,
right.
look at this, from 5 to 6 is this. See how those numbers change below? They
Yeah,
change dramatically. They change logarithmically. So it's not straight line. It's from a 3 to a 2. It's not double.
that's
It's
right.
quadruple.
That's right.
Anyway.
Um, so look, I want to wrap up
Anyway.
a bit on the business. I appreciate all that. I actually could keep going for a long time, but I don't want to hold you here all day. Um, what was the impetus that had you jump at Appian? You alluded to it, but like the entrepreneur always has a moment of truth, I think, where they just choose to send it, right? Like there's not sometimes it's very preconceived and meditated, premeditated, as we'll say, and it's a big plan, and the sky's open and away you go. It sounds like you may have faced some adversity with an individual and then just said, well, okay, I'm out on my own. I'm curious, like where it starts. What was that?
Yeah, I mean, I'll say, maybe there's similar attributes in that it's scary, without a net, at least for me. I grew up blue collar, so I had no fancy relationships or money. um, and so it was scary, and what brought me there, which I see in I have friends who are entrepreneurs who they are just fearless and they just go in, and it's easier to do that if you do have a kind of some safety net or cushion. But
Hmm.
still, it's or if they don't have a family, which I didn't at that time. Um, but mine was more. I would have just kept going and not pivoted. And so mine was. It's not out of being desperate, but like that just that's why I said I was lucky to have been in a spot where I just said, this is untenable. I have to move out. Um, and then one of the partners, one of the financial backers of that company said, "Oh, so I imagine you're going to start your own company." And I said, "Yes."
Uh-huh. Of course I am.
And a little adrenaline rush, and I was like, yeah, yeah, I'm just, this is the time to try this because I want to do that. Um, I don't think I'm built as a wonderful employee. And hats off to people who who mix well in that way. But so that was my, that was my little genesis, and it came that way, and I have kids and try to describe to them that it's really um, if you can go and be your own boss, as it were, uh, or do your own venture, yeah, then oh my gosh, it's so rewarding. Um, and part of you know what kind of squished my enthusiasm in those big companies was they were large. I didn't want to be my boss's 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 boss, and
Hmm.
the owner of the companies was just a family, Franklin Templeton, and like this is not, I don't have any kind of soul stirring anything going on here.
And
But
no impact, or hard
yeah,
to discern impact, right?
yeah, exactly. And I think that just not just the selfish quality of life stuff, but just I want to go do things, and I'm not trying to you know boil the ocean or be do big just raise funds and be big. We're not trying to be big. We like our niche, um, and that's what's and while it's there, maybe the crowdfunding will make it go away after a while. I don't know, but it's just fun to do. It's these relationships. You can the best relationships are those that are organic, and we don't like it's not there's not forced. Um, and when you find folks that you truly appreciate doing business with, and you get to do business with them, that's just great, And maybe it's less business. I know that we could. I've been offered to big things where we could go national and everything, but I don't want to be cliche and say quality of life, but it just makes work more fun, and the quality is better, and everything's on an upward
Yeah,
spiral.
it's funny that um, it sounds a bit cliche, and I remember when I was new to the business, having it told to me, over and over, like, "Hey, it's a relationship business." Boy, at this point, like, I don't think that can be overstated, as cliche as it may sound. It's
Yeah,
to me like there are so many attributes of real estate that are fascinating, and you're touching on a bunch of them. But the thing that is really, I think, spectacular is the people who are in the business, and the fact that you get to conspire together to do
exactly.
to do cool stuff, right?
Yeah, yeah,
Yeah.
yeah.
So,
It's exciting and fun for me, and yeah, I hope my kids can find something that's as rewarding, uh, just you know, hey, look at we built this thing. You know, happy tenants, happy investors, happy buyers. Let's do
happy
some more.
community.
Happy community, yeah, and it's done responsible. The city loves us. Gosh, let's just do it again.
Yeah.
Um,
What's the accomplishment that you've had with Appian, which you, or one of the accomplishments, rather than ask you for perhaps a pinnacle achievement, but what are you proud of having accomplished with Appian?
um, you know, I think that well, selfishly, it affords me, a fulfillment which my kids can witness, and
Mm,
that is a big deal for me. Uh, my dad he was a civil engineer, worked for this city, and he loved what he did. And I saw that, and absolutely not for me. Um, but that's fit him. Um, and so, there's no like, particular building or project. I think it's just, just a, a system, a way of living life that is fun, and finding fun in what you do, or enjoyment. Um,
it strikes me as almost like the thing that's popping into my mind is some kind of remarkable athletic endeavor, which done by the person who's a practitioner of it doesn't seem that far fetched, but perhaps as a father and as that athlete, if you will, on this strained analogy, uh, you're executing these moves and having the opportunity to explain to your children that, like, no, look, like, you can do it, like, you can do this. And they get to see, like, whoa, dad just like started his business and we're doing pretty well.
Yeah, and from the outside looking in, it can look complex or whatever, but gosh, we know, I mean, gosh, you can just boil it down to some basic things, and it's really not rocket science. If and there's a lot of germane knowledge, but once you get a hold of that, um, it's fun to and it's born. You have your failures, uh, and my failures are more along the lines of picking poor sponsors. I kind of alluded to it a little bit in that first decade of business. Like, oh gosh, you know, a good sponsor can take a challenging business plan and navigate around the rocks and get to the beach, and then a poor sponsor or partner can take take the easiest down the fairway thing and screw it up. Um,
Hmm.
and
Do you have any failures? Keep it as generic or specific as you like. Which, well, look, I heard somebody say recently, experience is what you get when you didn't get what you expected. Do you have any, favorite failure that maybe taught you some stuff you
well,
needed to know?
we built a gas station and a few a C-store and some fast food franchises in in Central California, and oh my gosh, they while we were closing on it, they built the off ramp to our site. It was just so our basis was massively low. I mean, we were getting offers along the way, and our our partner decided to yeah, it's like, this is not Taco Bell. It's just a bunch of recipes. I'm just going to make it my own restaurant here and not pay them. And we're like, yeah, that's a very poor decision. So we had to take the reins from that. But
Yeah,
it was
well,
just
that's
nearly insane idea. But that was when we were putting the property more than trying to look around him as a sponsor.
yeah, understood. So look, with 20 years of flag flying, we have money kind of flag up there. It's clear you've got more than sufficient deal flow, and my uh, expectation is that deal flow shows up in a whole array of ways, which is to say, not just, hey, here's another deal, Appian could fund it, but guys who say, you should come out of this, ad hoc syndicate model and build a $1 billion fund, or hey, we
Mm-hmm.
should franchise you guys out and do this nationally, or.
Yeah.
My point is, there's undoubtedly a lot of opportunity coming to you. I wonder how you stay the course, how you respond to opportunity as you hit a point where it's undoubtedly all around you.
Yeah, it's interesting you say that. I mean, over the years, there's there's folks who like want to bolt on but and make us a lot bigger than we are. Uh, and while, but maybe the dollars are sexy, but back to what's exciting is just doing the business that we're doing, and so while now we are, there's some investors who need to invest in a fund, and so we're raising some funds for those folks, but still they'll act as our um, our just kind of as Uber investors in our platform. um, it's also I used to look at some people say, oh, you have to herd a lot of cats. Well, we don't really. I enjoy. I mean, that's why this podcast is so long, because I will talk about me until the sun sets. I just love this business and everything, and so I enjoy all those interactions um, because um, I don't know. It's just it's I find enjoyment in what we do and what we conceive to do. So it's an interesting time. There's so much money out there, and um, I don't know. I think that we could go different directions. If something is intriguing, we can do something parallel, but alongside our existing business. But I don't know what that would be.
Right. Basically, you're just staying in your lane.
Yeah, 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 yeah.
I'm going to change topics a little bit here, but it kind of ties into that notion of opportunity and saying no. This may well be the pot calling the kettle black, and I'm certainly making an assumption here, but I've had a fair bit of interaction with you over the years, and I would suggest that we might both be quote unquote adults ADD, and I find that the world presents a lot of you actually used the word shiny stuff or something
Yeah,
shiny just a bit ago. um
distractions.
yeah, distractions, noise, whether it's this text message ding on my phone which I can't seem to have the discipline to just shut off, or the endless flow of emails, or the just I feel like there's a number of bullets flying through my body at any time, and they're just other ideas and other notions, and
Yeah,
keeping that all at bay so I can be still and productive for me
yeah.
is a real challenge. And if I'm completely off base there, I guess I'll say apologies, but I'm wondering how that shows up in your life, and how you mitigate the cacophony of life. You have children, you have a business, you have partners, you
Yeah.
have you know
For my mental health, I exercise. I would be a disaster if I didn't put out a lot of calories exercising. Uh, so I'm on my bike a lot and other stuff. But uh, I don't know. It's a reframing that the pandemic brought us to. Where uh, the travel simmered down a lot, and I have a hobby of woodworking, so I'll be making stuff in my shop, and then taking a call and moving on. And I'm not, I don't look at like, oh, and I'll retire at this. This is what pumps my blood, so I'll just keep on doing this uh, until I fall over, probably. But on my terms at a different pace. Uh, um, but I don't know. I think uh, I think that's I just try to be present. Especially for my kids, they're gonna be gone in a minute. They're teenagers now, and so they're
hmm
gonna be out of the house, and so trying to suck the marrow out of this phase, and appreciate that. And sometimes that means just letting go to voicemail and then picking up the next day and blocking off that time and prioritizing, actively prioritizing. But
hmm
uh, I don't know, you're probably better at it than I am.
I don't know. I don't know. Look, you just alluded to exercise, which is one of the things that I also find, in particular, outdoor exercise. Like I'll spend
Yeah,
more time than I'd care to admit on Peloton during
yeah,
inclement weather and things like that. But I also have an affliction for the bicycle, but
yeah,
I try to like start my day right with the expectation that if I can kind of get my head in both the short term and long term time frame, and come into the day clear with what like who I
hmm,
want to be and how I want to show up as a husband, a father, and a brother,
yeah,
a business owner, a service provider. That I might have a good day, and then if I can string a whole bunch of good days together, then um,
there you
the
go.
probability of me like going to the places I aspire to go is higher. I wonder what you might have by way of, if any, daily routines that you employ to kind of keep you on track.
Well, I mean, you touched on something there, and I think it's just, for me, that just means being intentional. Um, and when you find that you are just going through motions, but to analyze actually what look at what am I doing, and am I being intentional with my energy and in my mind share? Uh, um, and does that actually correspond with my priorities?
Mm,
And those priorities which I just alluded to, I can just like, okay, when it comes down to, okay, should I go to Phoenix, or or go to my daughter's volleyball game, or stuff like that. I know that's kind of a low hanging fruit to allude to, but um, I think that everybody has their little routine. Mine is usually wake up and I drink a coffee while I'm on a stationary bike, and that starts my day. And then I'm kind of getting my what would otherwise be a ride to work on my bike.
yep.
Uh, and so that's my start, and I frame out my priorities then. Or that happens at 4 a.m. in the morning, and I wake up thinking, oh yeah, I do that.
Yeah, yeah. Look, in fact, I didn't know what you had shared in terms of the blue collar um, upbringing and
Yeah,
the role model you had as a father, and so you have clearly made that journey, transformation from I have a notion that I can do this to like having fully accomplished it
yeah,
for either or maybe both the developer who's out there. These guys, you are partnered with these guys that you know in particular the guys that are getting going, or for other entrepreneurs in other industries or other aspects of the real estate industry. Do you have any thoughts, or dare I say words of wisdom, that you would share based on the journey you've undertaken?
I don't think that there is a waiting for a perfect time is is it's not going to happen. Planning, saying, okay, now I'm just wait for the market to dip, then I'm going to make a move or something like that. I think that that could expand, that time could expand out forever. But to just jump into the rapids and get in, kind of uh, um, get that experience of a small deal, starting small. Our first deals were very, very small. I was scrambling around for $1 million, and one guy lent me $30,000 because another investor backed out at the rate of 2% per month. So I was like, oh,
Wow.
and I replaced that money in 15 days. So that was small and quirky, and oh my gosh, the deal now, like, oh my gosh, but it's all a path, and if you yeah, I think about or get too focused on what I need to be in the future, but as opposed to just finding moving forward on something that's actionable right now, even though it's small, and the profits aren't big or whatever, but it's personal growth, momentum, and there's all these other things that you know like maybe my kids don't like taking a certain class right now, but they will benefit. I think they'll look back on it and go, oh yeah, that was, I didn't realize it then, but now I'm glad I know something about art history or whatever it is. Um, so I think that perspective, you're not going to have a fully formed perspective in the moment, um, but just follow your kind of gut in terms of just action and momentum is very valuable right then.
Yeah,
More so than having a full framed business plan or idea of where you're going to be.
I agree with you. And I think the funny thing for a lot of entrepreneurs, some number of years into the journey, if you ask them, you know, knowing what you know now, would you have done what you did? Um, you know,
Right.
because they've made it, the answer would be yes. But I think the vast majority of people just jump and then they look and then they go, holy cow, I had no idea what I was
Yeah.
getting myself into.
Yeah. Yeah. That's for
Yeah.
sure.
Look, you've been very generous with your time. I don't want to cannibalize any more of your busy day. If you have any closing remarks, or if you want to share contact info,
Yeah.
At your discretion, feel free.
I don't have thank you so much, Kevin. You've been, like I say, I'm enthusiastic more about people that I do business with, and you've been a good sounding board and buddy for a long time, and I vastly appreciate that. And this has been fun. And appiancapital.com has our information, but
Okay, perfect. Thank you, Jon. Listeners who've come this far, I have to remind you or invite you, please, to review the podcast if you like it. My production people keep telling me to say that. Jon, thank you. Listeners, thanks for joining us, and we'll catch you on the next episode.